Hey YouTube family, it's Dinko The Realtor. Today we're going to be analyzing what's going on in the economy, what could cause potentially a recession, and that housing hasn't maybe fully actually stabilized at all. If we take a look at this, Wall Street's dream scenario is dead of a soft landing, and maybe the recession is knocking on the door. Look, this kind of data information analysis, you're not going to be able to get anywhere else. Do me a favor, smash that like button, hit that subscribe button, help me grow the YouTube channel, and remember, when you need a realtor anywhere in Utah, Dinko the Realtor has your back with data information that you're not going to be able to get anywhere else. And I have people reaching out to me want to strategize. Everybody's, needs are different, and they want to look for things that are specific to what they're trying to accomplish. Don't hesitate to call. The contact information is down below. So I'm going to try to go over this really quickly. It's a lot of information, and you're going to want to watch this until the end because there's a lot of information in the economy that's going on. So you have the information you need to make a decision you feel comfortable with for yourself, your family, and those financial decisions are big time decisions. So we want to make sure we have all the data for it. Let me scroll down here, and right here we see that Wall Street's dream of a Goldilocks scenario for the stock market and economy is probably dead, at best severely wounded. Well, what the heck does that even mean, right? Well, it's saying, hey, it's probably dead, so that soft landing isn't probably going to happen, and a recession is more and more likely, and maybe that soft landing has a small possibility, but really that the recession has a much bigger probability. I mean, that's kind of what I'm interpreting there. I mean, when you kind of play with these words, so you got to read between the lines and think about this. The politicians, the Fed, Jerome Powell, they can't come out and say we think this is going to break, we don't think that the economy is going to be resilient, because that panic alone would cause a collapse, just like with Silicon Valley Bank, which actually kind of helped the market stabilize and start going back up. We'll go over that. So the panic is what they don't want to cause. So that's why it's our responsibility to make sure we're making decisions we feel comfortable with. Right here, it's already been tough for investors to watch the 10-year U.S. Treasury yield surge from 1.1% in January of 2021 to 4.84% today. And right here, the thing is, it has now spiked a full percentage point over the past 10 weeks alone. So in the last 2.5 months. Well, what the heck does this even mean? If you didn't watch those previous videos where we went over the 10-year, don't worry, got your back. We're going to go over this really quick. This is the 10-year. So when the 10-year goes up, interest rates go up. And over here is when money was free in 2021. So everybody was able to borrow money for minimal percentages. The Fed rate was 0%. We had all the stimulus money. We had the PPP loans, and the economy was overheating. And Econ 101, at least this is what I learned when I was getting my degree in Econ, is you overheat an economy, you cause a potential for a more severe recession. That's just Econ 101. So right here, when you're overheating that economy, they put all this money in, and now it's become real, right? So we see that interest for the 10-year right here at the end of 2022, when everybody was talking about a recession, then the 10-year started coming back down, then it went back up, and then it severely came down. Well, why the heck did the 10-year come down from these highs that we were seeing at the beginning of the year? Well, it came down because Silicon Valley Bank collapsed, the government bailed them out, and everybody was saying, oh, I guess everybody's going to be getting bailed out probably. So the economy, the consumers, and the student loans didn't resume, and consumers were able to weather the storm. Well, no, really. I mean, you're bailing out all these banks, you're not turning on the student loans, and you're saying consumers are resilient. Well, they're resilient because of the things that you're doing. And all those millionaires and billionaires with Silicon Valley Bank, they should not have been bailed out 100%. But that happened, and then all of a sudden the economy picked back up. Yet inflation was not tamed. And that's why I said that surge where those prices went back up about 7% was going to be short-lived. And based on the data, it was starting to mimic again at the end of spring what was happening last year when the housing market went down 15%. So it rebounded 7%, but things have not fully stabilized. So that's just your 10-year. You follow the 10-year to follow the interest rates. And this is also an issue because of all the variable interest rate loans. Variable means that the interest rates change. Commercial real estate has over $2 trillion of debt that is going to be on a variable loan that's coming due here at the end of 2023 into 2024 and 2025. There's also debt from all of the companies. You have your collateralized debt. So we're not even going to get into all of that. Let's just try to kind of go over this stuff here really quickly, and we're going to try to scroll down here. So right there, Jerome Powell said, hey, the path is narrow. The interest rates are going to stay higher for longer unless something breaks in the economy. And that's why you saw the stock market start tumbling downwards. And then right here, With interest rates exceeding levels not seen since 2007, investors and consumers are growing more concerned that something in the economy is about to break. And this time they say, it's not going to be 08, 09. Well, the thing is, there's a lot more different bubbles and a lot more dominoes that could fall this time around. And we don't need an 08, 09 for a recession to be pretty decent, right? Half of 08, 09 isn't great. 25% of 08, 09 isn't great. So right here, if you click this hyperlink, it takes us over to Karen Kimbrough, LinkedIn's chief economist, is among those that aren't so sure that the US economy can avoid a downturn, despite some recent data supporting a no recession outlook. So if you look at any macro data leading up to a prior recession, it's always good until it isn't. And that's what I've been saying. It's always going to be good. The government's not going to come out and say, hey, this is going to happen, that's going to happen. They don't want to cause that panic. So it's our responsibility, like I keep saying, to make those financial decisions we feel comfortable with. And of course, it's going to look good until it isn't. And the economy hasn't stabilized. So how can we say that the housing market has stabilized? Let's go over here. And oh, my computer was doing this and it's doing it again, isn't it? It's making things very, very blurry. I'm not sure why it's doing that. It's actually not doing it on the recording side. It's just doing it for me. So, hey, I'll deal with it. So we see what happened with inflation. Inflation skyrocketed over here. And then it looked like it was coming back under control. And then it ticked back up, right? So that's where I've been saying the Fed is between a rock and a hard place. They have to tame inflation at the same time trying to avoid a recession. And it's making it very, very difficult. And priority number one is bringing pricing to become stable. That's what Jerome Powell said. And if things break outside of their control, well, then they break. And then that's what would cause rate cuts. Well, if you have rate cuts because something broke in the economy and unemployment goes up from these historically low levels, that's not going to stabilize the economy. That's not going to stabilize the housing market, at least in my opinion. Again, you be the judge of that. And also, if I've been saying and following the data that at the end of 2023 is going to present a much better buying opportunity than if you did buy in that spring and beginning of summer when there were a good amount of multiple offers out there. Seems like that's becoming accurate as inventory is going up, days on market is going up. We're seeing more and more price cuts. We're seeing those prices starting to drop, and we're seeing that inventory increasing month over month, week over week. And so, builders are saying we're going to finish your free basement. They're slashing prices by $50,000, $100,000. They're giving more and more incentives. That's indicating that things haven't stabilized and builders have to sell homes. So the fact that these sales are down severely, like we went over the previous video, is not a good thing for builders. So maybe housing or maybe the builders are going to have to start, discounting their inventory to start selling it because the shareholders, they're not going to be happy when they see these numbers coming in lower and lower and lower. So there's a lot of stuff that's going on. It's unraveling, and I don't want to re-record this again. So let me it's good on that side. So right here, investors and banks are sitting on massive losses on their bond holdings that rival the full-blown stock market crash, with bonds maturities of 10 years or more down a whopping 46%, on par with the dot-com bubble burst in 2000. And this is something that I've been saying. We have a dot-com bubble again here potentially because of all the tech startups. Money was cheap. More tech startup companies came up during the pandemic than any time before, and majority of these tech startup companies are not profitable. Hence a correlation with the dot-com bubble. In 08, 09, you did not have a tech bubble because the dot-com bubble of 2000 was still in everybody's mind and saying, hey, we need to be wary of tech. Tech isn't, this savior, it is stocks, and these stocks, stock market crashed because of the dot-com bubble. Well, now everybody was over-investing into tech. So now you have housing, you have car loans, you have the tech bubble, you have commercial real estate, and things just keep kind of, consumer debt, all of this thing. So right here, the consumer, meanwhile, is getting pushed to the limit. Credit card debt has surged above 1 trillion. Delinquency rates for auto loans and credit cards are on the rise. Like I've been saying, things are not stabilizing, right? So if we go over here, we see that the surge in credit card delinquencies might be, signs of a coming recession. That's what Wells Fargo says. And right here, we see that credit card delinquencies are surging and it could signal a recession. Late payments on card balances outside of the top 100 banks notched up to an all-time high. So if you're having, you just see all these correlations, all these things are happening. And how can you say, that things are just going to be 100% stabilized? So right here, You have strategists at the bank, credit card delinquencies surging among commercial banks and banks outside of the top 100 in size and assets. Late payments on credit card balances hit an all-time record. So that's not a good sign. It's putting pressure on these smaller banks. And then we know that the banks also got downgraded. So it wasn't just that the economy got downgraded, but it was also that banks got downgraded. So not just the US government. I did not put the charger on here, so we're going to have to start wrapping this up here. I'm going to go through this really quickly. So right here, oh, and then this computer just died. So, oh, there we go. I'm having technology issues everywhere right now. I'm not sure what the heck is going on. So I have to re-record it last time. So let's see here. Just one second. Oh, right here. So we see that in 2022, 91% of CEOs said they anticipated a U.S. recession in the next 12 months. Then we had the, bank bailouts and everything like that. So now things are looking at the recession sides again. We go over here, could tip into recession within months. New Bloomberg model shows a better than 50% chance of a recession to begin this year, and if not at the end of 2023, it could become official in 2024. So if things are unraveling everywhere within the economy, within even housing is not, the sales haven't rebounded just because prices ticked back up. Well, if sales haven't rebounded, it means most people can't afford what's going on today. And maybe those sales rebounded because only the people that can buy, maybe only people that are really, really well off or have really, really good jobs are buying. And maybe that median price isn't actually the true median price that we're seeing. Because if we put the other 2,000 buyers that should have bought during all these other months, maybe that median price would have been down, right? So we have to kind of read between the lines. Do me a favor, smash that like button, subscribe. Until next time, have a great day. The next video that's going to be coming out is going to go over inventory, showing you the inventory levels that are kind of mimicking of 2019, and we don't have that low inventory that they're saying 2021 levels. That inventory is definitely not there. We had 2,000 houses to 3,000 houses, even 1,800 houses on the market any given day of the month, and right now we have over 9,000. So inventory is not as low as they're trying to make it out to be.